The story didn't start with a big announcement. It started with silence, a quiet shift inside China's financial system that almost no one noticed until it was too late. Traders across the world woke up to alerts they didn't understand. Liquidity screens were flashing red. Bid-ask spreads were widening out of control. Overnight positions were suddenly recalculating without warning. Something had broken, something big. And within minutes, the entire silver market realized that China had just pulled the trigger on a move worth more than $72 billion. For years, analysts had warned that China's grip on the global silver supply was far stronger than most people believed. But even the most experienced traders weren't ready for this kind of shock. Overnight lending between Chinese metals banks just froze. Export clearances slowed to a crawl. State-backed refiners received new internal orders labeled with a single cryptic phrase, strategic reserve priority. By the time the West got the memo, the shockwave was already racing across oceans. U.S. banks woke up completely blind. Their sophisticated models didn't catch the event because it wasn't a price crash. It wasn't a production halt. It wasn't even a public policy change. It was a liquidity vacuum. China had quietly absorbed $72 billion worth of silver-denominated contracts, credit lines, and short-term settlement facilities. They pulled so much liquidity out of the system that global markets were left gasping for air. Banks that had relied on China as a stabilizing counterparty suddenly found nothing on the other side of their trades. And for institutions already stretched thin, that was the breaking point. Inside New York, the first real warning came from a metals desk analyst who noticed that the cost of overnight swaps had doubled, then it tripled it, and then they disappeared entirely. It didn't make sense at first. Silver wasn't crashing, it wasn't spiking, it just stopped. Liquidity vanished as if someone had pulled a giant plug out of the bottom of the market. Within minutes, risk managers were calling senior partners. Senior partners were calling the Fed. And the Fed was calling the banks, desperately trying to understand why U.S. institutions were suddenly facing liquidity gaps they weren't prepared for. Nobody wanted to say it out loud, but everyone knew the truth. China had just taken control of the world's silver flow in a way that left the entire Western financial system dangerously vulnerable. The shockwave spread like a slow-motion explosion. Silver ETFs began showing unusual withdrawal patterns. Industrial suppliers started reporting mysterious delays. Bullion banks in London raised their margins without any explanation. All the signals were clear. The market had lost its balance, and the center of that imbalance was Beijing. The official story from China was deliberately vague. Something about domestic optimization, resource stability, and inventory recalibration. These are words that mean absolutely nothing. Words designed to distract. Because the real move wasn't about policy, it was about leverage. China had created the largest liquidity vacuum in the silver market since 2011, and they did it with absolute precision. They knew exactly where the pressure points were. They knew which banks were overexposed. They knew which markets would panic first. And they were right. By midday in the U.S., whispers started to spread across Wall Street. Two major banks had already tapped into emergency funding after their silver obligations became too unstable to manage. Not because they had lost money, at least not yet, but because their counterparties had simply vanished. Without China's liquidity, these banks were essentially holding contracts backed by nothing but air. And when a market worth hundreds of billions of dollars suddenly becomes illiquid, even the smallest imbalance can trigger a catastrophic domino effect. Trading desks were given urgent instructions to minimize exposure. Analysts were told to reassess risk weightings. Compliance teams were ordered to review leverage positions immediately. The message was clear. The system was under extreme stress, and nobody wanted to admit just how fragile it had become. Meanwhile, something uncanny started happening in the physical market. Dealers noticed a sudden surge in premium requests. Not actual purchases, just requests. Customers were calling in, wanting to know how fast they could get physical silver if the market completely froze. They wanted to know if their existing orders would still be honored. Some even asked if they could drive to the warehouse and pick up their purchases in person instead of waiting for shipment. Fear was growing. This wasn't panic, not chaos, but a quiet, calculating fear. The kind of fear that creeps in when people sense something is deeply wrong, but can't yet explain what it is. At the same time, hedge funds tried to arbitrage the liquidity gap, but their trades failed. The gap just kept widening. And then it widened again. Because the deeper issue wasn't price volatility, it was structural. China had effectively cornered the market's oxygen supply. They didn't crash the price, they didn't pump the price. They simply reduced the flow of liquidity so dramatically that the entire global system was forced to adjust. And that adjustment was brutal. By early evening, the U.S. Treasury had convened an unscheduled emergency call with the heads of major financial institutions. The conversation was described by insiders as urgent but contained, which is code for a situation that is extremely serious but not yet public. Officials wanted to understand why several banks were showing sudden, severe stresses in their metals divisions. They wanted to know why silver settlement flows had slowed to a trickle. They wanted to know why reports of margin irregularities were popping up across multiple platforms. But no one had a clean answer. Because the truth was deeply uncomfortable. The West had fundamentally underestimated how much of the global silver liquidity architecture depended on China's participation. Not the supply of silver, not the mining, not the refining, the liquidity, the credit structures, the swap lines, the silent backbone of the silver derivatives market that most investors don't even know exists. China didn't break the market. They simply removed themselves from it. And that was enough to break everything else. The night ended with Wall Street analysts calling the day concerning, unexpected, and highly unusual. These are carefully chosen words designed not to alarm the public. But behind the scenes, the internal memos were far more direct. Some banks were advised to prepare for extended periods of volatility. Others were told to immediately reassess their entire exposure to silver-linked assets. A select few were asked to provide confidential, hourly updates on their liquidity conditions directly to regulators. The signal was crystal clear. The system wasn't stable. It wasn't collapsing yet, but it wasn't stable, and the markets could feel it in their bones. China had made its move, and the world had just begun to understand the terrifying scale of it. The real shock wasn't the number on the screen. It wasn't even the $72 billion liquidity maneuver China pulled overnight. No, the true shock was how fast the consequences started to ripple through the U.S. banking system. It happened faster than any analyst expected, faster than any risk officer believed was even possible. The moment China's Metal Reserves Department dumped that massive liquidity order into the market, something strange happened behind the scenes, something that wasn't supposed to happen yet. American banks, the ones silently sitting on massive, leveraged silver positions, started receiving margin calls. Not just one or two, multiple calls. Some were small, almost insignificant, but others were catastrophic. And they all delivered the same chilling message. Your silver exposure is officially underwater. Add capital, immediately. And the banks weren't ready. You could practically feel the panic spreading across trading floors in New York and London. Phones buzzing incessantly, screens flashing a violent, angry red. Risk managers were seen whispering to each other, their faces pale as if they knew this day was coming, but had prayed it never would. Because here's the brutal truth nobody on CNBC wants to say out loud. U.S. banks have been using silver like a pressure valve. For years, they've used it as a tool to artificially cap inflation sentiment. The strategy was simple. Push the price of silver down, and you ease inflation expectations. When inflation expectations are low, the dollar looks stronger. When the dollar looks stronger, the yields on U.S. Treasuries look justified. It was a delicate, interconnected system designed to maintain a certain illusion of stability. But when China unleashed that $72 billion liquidity shock, the pressure valve broke. And once it broke, the U.S. bank's entire silver suppression system cracked wide open with it. The fallout was immediate and brutal. I spoke with traders inside JPM, Citi, and two major European giants, and they all described the same terrifying scene. One trader told me silver liquidity just dried up instantly. It vanished. Another said there were no bids, no depth. Prices were suddenly moving in 10-cent jumps, not fractions of a cent. A third, a veteran of 2 decades, put it bluntly, "We've never seen that kind of vacuum before." A vacuum in a market is dangerous. It's the financial equivalent of stepping off a cliff and finding nothing but air. A vacuum means there is no one left on the other side of your trade. It means the banks can't hedge their positions. They can't unwind their exposure. They can't escape. And then came the silence. It's a specific kind of quiet that only happens right before a market truly breaks. You could almost hear it, this eerie, uncomfortable pause. It was the sound of thousands of traders and algorithms simultaneously coming to a terrifying realization. China didn't just push a button. China exposed a fundamental weakness. Think about the timing. This was a $72 billion strategic strike, timed perfectly. It hit while U.S. market liquidity was at its lowest point. It came when hedge funds were busy repositioning for the end of the quarter, and banks were sitting on reserves that were thinner than anyone admitted. The shock hit the system like a bolt of electricity. Once that liquidity wave crashed, the silver market began to behave like an asset, trying to correct a decade of artificial waiting in a single night. Volatility didn't just rise, it exploded. The bid-ask spreads, the gap between the buying and selling price, widened like a geological fault line. And the banks panicked, because if silver jumps too fast, if all those short positions flip too quickly, if liquidity collapses again tomorrow morning when New York opens, the losses for these U.S. banks won't be in the millions. They will be in the billions, maybe even tens of billions. And the contagion was already spreading. In the Treasury market, alarms were already flashing red. The dollar index, that bastion of American financial power, twitched nervously. Over in Asia, futures markets went completely haywire. Then came the telltale sign that the fear was real. One of the big U.S. clearing firms, the financial plumbers that handle the back end of these trades, quietly raised its collateral requirements for silver contracts. Normally, they announce these changes days in advance to give the market time to adjust. But this time, there was no warning. Just a sudden memo that said, effective immediately. That's how you know the institutional fear is real. They're not managing risk anymore. They're reacting to a crisis. This wasn't China reacting to the market. This wasn't some routine liquidity adjustment. This was a move. A calculated, deliberate, financially weaponized move. And you can bet that Washington knows it. The Treasury Department suddenly called an unscheduled briefing. The Federal Reserve started making private calls to the heads of risk at several major banks. Hedge funds that had been riding the short silver trade for years began desperately trying to close out their leveraged positions, only to discover that the liquidity wasn't even there to let them exit safely. They were trapped. That's when the second wave hit. Offshore traders in Singapore and Hong Kong saw the U.S. panic and started front-running it. They knew the American banks were trapped, so they started buying silver aggressively. They pushed prices toward levels that the banks absolutely could not afford to see. Every dollar higher meant deeper losses for the bank's short positions. Every spike in the price meant another margin trigger being hit. Every minute that ticked by meant their unhedged exposure was growing exponentially. And in the middle of this chaos, traders reported one particularly chilling detail. They said some banks were bidding against their own positions. Well, let that sink in. They were buying silver in the open market, pushing the price up just to try and slow the bleeding from their massive short positions. That is the very definition of losing control. It's like trying to put out a fire by spraying it with gasoline. By the end of the trading session, one thing became painfully obvious. China didn't destabilize the U.S. financial system by accident. They simply revealed how fragile it already was. They pulled back the curtain, and what we saw wasn't pretty. And here's the part that nobody seems prepared for. We're only in wave 1 of this liquidity shock. This was just the initial tremor. Wave 2, my friends, is already forming. What we saw was a test. The real move is yet to come. The financial world is holding its breath, waiting to see what happens next. The game has changed, and the rules are being rewritten in real time. Thanks for watching. Make sure to follow for more updates on this developing story.